to be back, everyone. Yeah, great to be here with you all. I'm excited for today's session. Just to recap some of what Jason just mentioned, this is session 3, but it is the first one focused around infinite banking. So it'll be this week and then also next week. So 2 sessions on that. And then the culmination of the 5th session tying WBC and IBC together. And hopefully you'll start after today, start seeing some threads and some connecting of the dots to where they really kind of teed up all of these sessions together. So I'm excited for today. I feel like I almost want to start with this of what we went over the last 2 weeks with WBC is almost, gosh, I'm struggling with the word. I don't want to say easier, right? Like that's not where I'm going, but just follow my train of thought here. Like it's very, all we were looking at is what does the financial services industry recommend people to do by and large. And again, try to take all of my statements with that of a bell curve, that middle section. What does the financial services industry mainly recommend that people do? Just the average Joe out there. And then how can we enhance that? How can we think about that differently with some strategies backed up by third-party validation, verifying everything that I was sharing around low distribution rates and so on and so forth. So from that perspective, it's almost, I would call it like still in the same wheelhouse, right? Just beginning with the end in mind and maximizing distributions. However, these next 2 sessions are completely outside of that wheelhouse and completely against the grain, not just from a strategy perspective, but also from a philosophical perspective in some instances. Okay, so I just quickly pulled a handful of books off my shelf. I won't go through all of these, but I mean, there are so many. This one, The And Asset, awesome. Becoming Your Own Banker. My point in showing all of this to you is this is going to require further education. Okay, it is going to require studying and research and learning from others for potentially maybe some light bulbs to go off, and that's okay. I still remember the first time I was introduced to IBC happened to be kind of on the heels of just getting going with WBC, and I was like, oh my gosh, like these things go hand in hand. It's phenomenal. But I can remember reading this book, Becoming Your Own Banker by Nelson Nash. He's the one that gets kind of credit for coining this strategy. On the plane out to Salt Lake City, going through the book and like, oh man, okay, I can see where this is going. And then I was partnered up with a firm that was 100% specialized in IBC. Okay, so again, I just share that because there is so many resources out there today to get further information. And because this is so conceptual, what you're going to find is that advisors out there talk about it differently, and there's different names for it, and how they recommend utilizing it may be different. I'd say probably 80% of similarities, but then some 20% sizzle here and there. And I think that's good, because I think that is getting multiple perspectives, hearing other people use different language and so on and so forth. So I would encourage you, if especially after today or certainly next week, if this is striking a chord, if this is like, oh man, I need to learn more, do it. Take it upon yourself to go out there and better your business for that. So I'm excited for today, and with that, let's dive into it. There will be more times today for a little bit more interaction, so please don't be shy. Take yourself off mute, or Jason or Colleen will be manning the chat and ask a question or respond, whatever you might be. All right, so let's go ahead and dive into this. Make sure I share my right screen. Cool. All right, so I want to set the groundwork here that first, like many of you that have maybe heard about this or been exposed to it, you understand that, hey, we're going to get into some whole life insurance. Yes, we are. And we're going to get into quote unquote specific designs of the policy? Yes, we are. But we first need to start with the why, and we need to start with philosophically, what is it that we're after? And then, why the heck is whole life insurance the best vehicle for it? Is it the best vehicle, right? It first starts with level setting. What are we after? Okay. And I want to do that by just giving you a brief little story here and use some numbers with this. All right. So let's say that someone is just starting off in the workforce. They're finally just able to start saving some money. Let's just say they're 30 years old. Okay. And they're going to retire at 65. So we're looking at a 35-year time frame. Because they're young and just starting out, they don't have any money to their name, but they are earning $100,000 a year. Okay, whether it's one individual or household, doesn't matter. All right. Now, let's say that they're in a position that they're going to get raises, inflationary raises, or it's reasonable to assume that they might over those 35 years. All right. So let's just give it a 3% inflation rate. And let's say that every single penny of those earnings, every single penny, let's say that you could save 100% of them. Okay. Saving every dollar, 100,000 every single year for these 35 years plus inflation. And let's just say that you're going to stick it in a savings account and you're going to earn 3%. Okay. What this is showing here is what's called your maximum financial potential under these parameters. All right. So notice over here, these savings, if you were to save every penny of that, would be $9.8 million. Let me say it another way. You earning $100,000 a year, or your household earning $100,000 a year for 35 years, getting your inflationary raises every year, almost $10 million is going to pass through your personal economy. Okay. Meaning you are working for your cash flow, and the results, financially speaking, of that work generated $10 million for you. Okay. So level set where we're starting with this. Now, again, I'm showing you an extreme here, right? Because we could never save every single penny, because we got to eat. We have to have shelter. We need clothing, food, right? So let's look at, if this is what's coming into the top funnel here, subsequently, where does it go out? All right, so let's look at some of those main categories here. How about taxes? How much taxes is someone paying? And see, I feel like we've been conditioned to think, well, state and federal, maybe county, right? Financial, but what about gasoline tax, or tax on goods, tax on your cell phone bills, tax on the hotel that you just stayed at, tax at the rental car, right? I once, I bet if you go Google this right now, you can find it, but I once was looking at a list of every single tax that people can pay, and it's crazy. It's sickening how many there are, right? So let's just say that all in all right, someone was spending 35% on taxes in all forms. Okay. Debt service. There's been studies done that the average debt service, that meaning you're borrowing money for something. Okay, it doesn't just have to be our home or our cars like we might initially think, but you're borrowing money for something, and subsequently your cash flow needs to go towards servicing that debt, making whole on it. All right, I read a study recently that was saying that this was, for some people, upwards of 40%, but let's just call it 30% here. Okay, and then lifestyle. All right, well, the vacations we take, the cars we end up buying, how we consume our time, our other resources, going out to dinner, yada, 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 you fill in the blank. Let's just call that 30%. Okay. As I do each one of these, let's minimize that. Taxes, notice it was going to be 9.8 million. Now it's down to 6.4. Where did that go? Well, we had to pay taxes. And I mentioned this at the kickoff meeting, this idea of lost opportunity cost. If I can no longer earn interest on those dollars, what I could have earned is the lost opportunity cost. Doesn't mean that we can do anything about it. It just is what it is. Okay. So paying this money in taxes cost us the difference from 9.8 down to 6.4. Our debt service of 30%. Now we went from 9.8 down to 3.4. Okay. And then our lifestyle down to 490, 492. In fact, you know what? I'm just telling you that's low. Let's go 32% for lifestyle. All right. So now we're down to 300,000. Okay. Now, anyone want to take a guess as to what is the average retirement account balance when someone goes to retire today? Well, all things are relative, but it's fairly in line with what I just demonstrated here. So hear me on this. If you're initially having some beef or some concerns around, well, Brent, the numbers in those categories, overlook that for a second, okay? Here's the point. People are saving a very low percentage of their income. It's being consumed or it's being required that it goes out the door. All right. So we just recognized that $10 million was going to pass through our personal economy, but yet we're left with only 300,000. So what do people try to do? What does the financial services industry do to solve this problem? They first say, well, heck, this is why you need to get a rate of return. This is why you can't just save your money. You need to invest your money. And again, hear me with this. I'm not saying there's anything wrong with investing. Okay. We want to try to get the maximum rate of return on every dollar that we use once we understand its purpose. Okay. And that's a little bit of what we talked about these past two sessions. So let's go over here to the earnings rate. Instead of getting 3%, what if we got 6%? Let's see what that does. We were at 300,000. All right. Now we're at $500,000, a little better. Nowhere near, and check this out. If we were earning 6 and we were able to save everything, our max potential was 17 million. Again, we're not addressing that because we know that we can't totally save every dollar, but we went from 300,000 to 500. What if we got 10%? And remind you, this is every single year compounded 10%. All right, now we're up to about 1.2 million. Okay. So here's what I want to suggest to you. We are solving this problem of accumulating wealth inefficiently. Okay, now, again, distinction between what we talked about the last 2 weeks, it was every dollar that we're saving, let's make sure that we're positioning it in a way that gives us maximum income. Okay, so that we're still going to do that. But once we are allocating money to grow for the future, I will challenge you and say that, you know what, it's not getting this higher rate of return. In fact, let's go back to 3% here. Okay. Think about this as like you're a boat. Okay. Your personal economy is a boat that you are out in the ocean sailing. Okay. And every single one of these areas where money is going out, think of that as like a leak in your boat. And if we had the opportunity to plug some of those holes and put more money back on our side of the ledger, what type of an impact might that have for us? What if through some strategies and different conversations that we might have, what if we could lower the overall taxes that someone was paying from 35% to 30%? Okay. What if we could change the way we finance some of our major purchases in life? And what if rather than 30% going towards our debt service, what if 25% was going towards it? Notice what happened over here to the right. Without increasing my rate of return, by plugging up some of those leaks, we ended with about 1.3 million instead of 1.2. Okay. Now notice all that's happening here, guys, is when I was reducing our taxes and debt service, notice what increased our savings rate. Part of why Americans struggle today is because even if we could find those potentials to save more money, where do they want to add it? They want to add it to the lifestyle, right? So again, part of our job as an educator is to just bring this to light to them. Okay. So what's happening here is, look, if we can save money on taxes, if we can change the way we purchase some big ticket items, if we could recapture that, by golly, you need to save that money. And then let me show you how to best save that money. So the point with all this is every single one of your clients, probably every single person on this call, did not realize how much wealth was going to pass through to your name and how much is subsequently going out. And with this, I want us to focus on where can we recapture some of those dollars, and that will give us the ability not to have to chase rate of return and still have a greater impact for us. Now, for some of you out there, they're thinking, okay, well, what if we could do both? Well, hey, now you got the cat's meow, right? If we were able to reduce those and we were able to earn that same 10%, hey, now we're up to 5 million instead of the 1.2 where we started. Okay, so I'm just trying to level set here that what we're targeting through some of these conversations is different than the way the majority of the financial services industry goes about accumulating wealth. All right, and again, pop off mute, type in the chat if you have something. All right, so let's leave this for a second. And I want to get into really looking at, when you think of goods and services or experiences that you purchase through your everyday life, okay? I would say that there are really only two ways that we can purchase that experience or that car or that TV, whatever it might be. There are only two ways. Hopefully, you all would agree with me in that first way would be paying cash. Okay, we either pay cash for something, or what's the other one? Take out a loan, right? Debt. I can't afford it right now, but I can afford it over time and I'm going to pay it off. Okay, those are really the only two ways that we can acquire things. And I don't want to get into trade and all that sort of stuff. So let's look at what this looks like. All right, let's say here's a line and it represents $0. Okay. Now, for someone on the top half that is going to structure their finances in that, you know what, I pay cash for everything. I don't want to, get into debt. I don't want to overextend myself. I pay cash. Okay. In order to pay cash for something, what do you first have to do? You need to have cash, right? So absent of some sort of windfall that you come into, you need to first save up. Okay, so you're putting your money in your savings account or whatever it is, and you get to this point right here and you say, okay, I have enough money for that car, that vacation, that TV, that fill in the blank, if you're choosing to pay cash, and you take that money out and you go and you exchange it for whatever it is you were after. You with me? Okay, now, in assuming that because you're a cash person, assuming that transaction is going to be repeated again in your life, and you're going to still have the mindset that you're going to pay cash for it the next time, what do you immediately have to start doing? You immediately have to start saving again, right? And you get here, and that process just repeats itself until you end with $0. Okay. Now let's look at the other side of it. All right, let's look at debt. All right. It's really just the complete opposite. Here we take out our loan, right? Make sure it's a payment that we can afford, hopefully. And then we satisfy that debt over time. And then we do it again. And then we satisfy it over time, so on and so forth. And that process repeats itself until we're back at $0. Okay. So Brent, what's the point? Here's the point. The idea of lost opportunity cost, right? So what I want to look at is at this moment on the cash side right here. Okay. In this moment where we choose to exchange our cash for whatever it is that we were purchasing, we have now given up the ability to earn interest on those dollars moving forward. Agreed? So that would be this lifestyle pot right here, building it up. And then I want that new blah, go get it, right? It's then gone. So it's not on this compound curve here. All right. So how much are we giving up by doing that? It would be this point moving forward, the rest of our life for every single transaction that we do. This is our lost opportunity cost. Now let's look at the debt. Okay. With debt, not only do we have the lost opportunity cost on each one of these payments that we're making back, right? We're also being charged this little thing called interest. So we have lost opportunity costs associated with that as well. All right. Now, just because something is a fact doesn't necessarily make it good or bad, right? Like it is what it is. I mean, this right here is a fact. And comparing cash to debt, Brent, which one's better? Well, it all depends on how you're positioning that question. But I would say, as a general statement, I've seen many people, myself included, mind you, that the swiping the credit card has gotten them in trouble in the past, and they've overextended their cash flow. They're spending more than they should be, right? So I could make an argument that at least with cash, the likelihood that that's going to happen is less, right? So that's perhaps being a better steward of your resources. Okay. But it doesn't change the fact that because you are exchanging that cash, you're giving up the ability to earn interest on those dollars. All right. What's interesting about this too, mind you, is how does someone determine if they can afford that $30,000 car, $40,000 car, $50,000 car, $10,000 car, whatever it is. On the cash side, it's not necessarily do you have the money in your account, because how did we set this up? We set it up by saying, assuming this is going to be a repeatable purchase, the way you determine if you can afford it is, can you recapitalize? Can you, in your cash flow, still put money aside so that you can buy it the next time? All right. This is a cash flow issue. All right. Now, I want to, this is where I would either like someone in the chat or pop yourself off mute. But if I were to make the statement that we finance everything we buy, regardless if you are on the top half of this line or the bottom half, if I say you finance everything you buy, would you agree with me or disagree?
I agree.
Agree. Okay. Agree. And so why are you saying that?
Because we want to recapture everything that we spend and buy. So,
yes, you're absolutely right. Okay, I'm not going to fit this in here, but we finance everything. And it's because of this idea of, you may not be paying interest if you pay cash for that car. You may not be paying interest, but you're giving up the ability to earn interest. In fact, when you think of financing, what comes to your mind? Like if someone were to say, hey, throw out some words that define financing, what might you say? Or what might be some of these most common responses? I would say that it probably would come down to things like, well, interest, a payment, right? So on and so forth. So here's what I want us to realize here. This idea of payment, you are making a payment regardless of if you pay cash or you go into debt. All right, because the only way that you can do that again is you need to still make a payment to yourself, to your savings account. It may be on much more lenient terms, right? Like the bank's not going to say, hey, you need to put that $500 a month back in your savings account, or we're going to, close your account on you. Unlike, hey, if you don't pay your car payment this month, we're going to repo your car. It's different, but you still need to be making a payment. Okay. So you're giving up interest and it still requires a payment. All right. Now let's get back into then this idea of why whole life insurance. Okay. Why is whole life insurance the vessel, the vehicle for executing on mimicking the banking function in our life. And I'll further define that, maybe not today, but in the future. And here's why, okay? Well, there are many reasons, but at least what we've gone through to this point, here's what I want to hit first. Okay, so this curve here, what does this represent? That depiction?
Compounded interest.
My man, compound. Okay, exactly. Now, what is the driver of compounding?
Time.
Yes, sir. Exactly. The biggest driver of this is time. Okay. We all only get one compound curve in our lifetime. All right. And whether it be by choice or life circumstances, whatever it might be, I think it's common that people feel like financially they need to play catch up at some point in their life. So they get to, here, and they say, all right, kids are out of the house, blah, blah, blah. Now I can really start stocking some money away. That's great. It's certainly better than the alternative of not, but time is what drives this. That is why the quicker we can get our clients to recognize you get one compound curve in your lifetime, let's try to get on there as quick as possible and get as much money on that curve as possible is a very, very valuable thing. Okay. Now, a little bit of a soapbox there, but here's why we utilize whole life insurance. One of the reasons we utilize whole life insurance in order to do this. Okay. Think about this compound curve and the difference, what whole life insurance allows you to do is when you get to this point and you've built up some cash value in your policy, okay, and you want to go and purchase that car or again, fill in the blank for whatever it might be, instead of taking it out and needing to start that compound process all over again, thus over time, right, missing out on all of this woulda, coulda, shoulda of compounded wealth, just like this is exactly what would happen in a savings account, right? That's what we saw in that calculator. It's coming out and therefore it doesn't have the ability to compound any further. What whole life insurance gives us the ability to do is when we get right here, this first red, and we say, hey, we're going to buy that car, we get to borrow against that cash value, go pay cash for the car, but then we get to pay this back over time without interrupting the compounding cycle. Okay, so that at the end of time, we put as much of this wealth back in your pocket. Okay, it doesn't mean that you're buying different vehicles. It doesn't mean that you're taking different vacations. It doesn't mean all of that. It just means that we are going to acquire it differently. And because we have access to a financial vehicle that allows our capital, our cash, to continue to grow while we utilize the purchasing power of it for some other good or service or whatever, is extremely beneficial. Okay, let me just pause for a second. Does anyone need to come off or type in the chat?
Just one thing to kind of emphasize there, Brent. What I love about how you're beginning this here is, I think where we tend to go with making a case for infinite banking concept is how it's better to kind of be our own bank and avoid paying compound interest. But the compound effect of investing and saving is huge. And that's what you've just illustrated here. So whether somebody tends to be a debt user or whether somebody tends to be that saver, you're really giving us a way to make a case to both categories.
Totally. Thank you for clarifying that or emphasizing that. Yeah, absolutely. And I through today, I think you will walk away here with maybe some ahas, especially an example I'm going to walk you through, but you're going to be like, okay, I certainly need more. And so I'm going to try to deliver on that next week as well. But here's the first basis as it pertains to the idea of lost opportunity costs and having our money continue working for us as long as possible, even though we need to utilize it, can have the same or a greater impact with taking less risk than if we go try to chase rate of return in the stock market. Okay, Nelson Nash would say that replacing the banking function of our life internally is by far the greatest financial benefit that anyone could ever do for themselves. Okay, now let's go on a little bit further. So that was the first piece of why whole life. Now, again, there are other things. I don't mean to minimize them, but leverage death benefit, creditor protection, privacy, off of FAFSA forms for college aid. I mean, there are a number of them, but just in the context of what we're talking about right now, that's the biggest one I want to go over. So let's look at this, for example. What is happening? I am a stickler when it comes down to language. Okay. And one of my first classes that I went to, learning more about this, gentleman next to me had said, well, when you take a loan from your cash value, why do you have to pay it back? Because it's your money. Like, why do you have to do that? And the person teaching the class, name's Todd Langford, he said, all right, you have a couple things going on with that question, but let me start with, you are not loaning your money. The insurance company is loaning you their money with your cash value as collateral. Huge difference. Huge difference. So let's start to take a peek at that. All right. Let's say that this represents someone's policy. All right. Cash value. All right. And let's just say that for the sake of this discussion here with how we're going to look at it, let's say that there is $50,000 inside their cash value. Now, we all know that the only way cash value gets in there is you need to first deposit money, right? Think of a bank. It takes depositors money on, influx of money happening for them to turn around and do what they do. Okay. So maybe it takes 15 years for someone to build up 50,000. Maybe it happens after month one, all depending upon the size of which they are depositing, right? So don't get hung up on that. Just for the sake of this discussion, $50,000. All right. Now, once it is in your cash value, it is now earning interest. Okay, interest and dividend. Now, dividends by their nature are non-guaranteed. No mutual insurance company out there can tell you that their dividend is guaranteed. If you hear someone say that, raise your ears, because they're not being a stickler with their language. Might they say, hey, we've been in business for 140 years and we've never not paid a dividend? Would that be factual? Yes. Still doesn't make it guaranteed. Part of that reason, by the way, folks, is it's not that the insurance company is like trying to pull a fast one on you or trying to reserve the right to not pay one in the future. It's more of the dividend reflects the profitability of the company, and they simply don't know what it's going to be on an annual basis, right? Think of it like that. So no insurance company can say that it is not guaranteed. All right, so that it is guaranteed. So interest and dividend. Okay. Well, at the same time, put this up here. Here is the insurance company. The insurance company will give you a loan up to 100% of your cash value. Now, again, what's happening here is, hey, Brent, you got 50,000 in your cash. You want a loan for 50,000? Okay, here it is. The insurance company literally gives me their money with my cash values collateral. So if I said, hey, insurance company, can I have a loan for 60,000? They'd say, nope, because you don't have 60,000 in your cash. All right. This is the maximum amount. But this loan is unlike any loan out there. Okay. In the marketplace. All right. I will also kind of tee this up. It is the most secured loan ever. Okay. And we'll visit why here in a minute. But here's this loan. So if I want 50,000, there is no filling out long paperwork, explaining what I need it for, verifying my proof of income, running my credit. There's none of that. The insurance company is simply going to ask me, hey, do you want that to be EFT'd to you, or do you want a check in the mail? That's it, right? There is no credit check. No credit check. And let's say, boom, I want a loan for 50,000 because I'm going to buy a boat. I don't care, whatever it is. All right, so there's no credit check. All right. The next piece of this is there are 0 repayment terms. 0 repayment terms. I'm going to dictate how much I'm going to pay, when I'm going to pay it, if I'm ever going to pay it. I control that. Now, wait a minute, time out. How does that work? Well, let's first contrast it to any loan out there in the marketplace. Okay. If you buy this boat through a conventional bank, credit union, whatever, and you end up losing your job, and so you miss your payment this month, and then next month, and the following month, what's going to start happening? Hopefully you're thinking like, oh man, my credit's going to take a whack. Yeah, your credit's going to get dinged. And if it goes on long enough, they're going to come back and they're going to take your boat. And why is that? It's because you violated the repayment terms. You promised to pay X amount per month until that was satisfied. The fact that you lost your job or fell on financial hard times, they may fake cry for you and tell you that they're very sorry, but they want their money. Okay, that's how this works. Inside of the policy loan, there are 0 repayment terms. I have heard countless stories of business owners being able to make payroll because they were taking a policy loan. Great story. You can find out where did Walt Disney get the funding to create Disney World? You can go research that one. Kind of cool. All right, but there are 0 repayment terms. So no proof of income. No. Yeah, go ahead, Jason.
Could you address just a couple real quick questions in the chat?
Sorry. I don't have the chat.
No, we're watching it for you. So what affects the dividend, the cash value or the amount of death benefit?
Well, so gosh. Here, what is the definition of a dividend? The definition of a dividend is a return of excess premium. What does premium buy? Premium buys a death benefit. Cash value is contractually guaranteed to to equal the death benefit at maturity. Mm-hmm. It's all intertwined, but the more death benefit you're buying comes with a larger premium, comes with more cash value, will come with a larger dividend than same rate, but value than someone that's doing lesser of that. So it's all intertwined. An actuary may have cringed with what I said, but that's pretty darn good for at least the way we should think about it.
Awesome. And then the other one was they were mentioning a case with One America where it didn't seem like the clients could take out 100% of their cash value for a loan. Okay,
so part of that comes down to how insurance companies will credit this. All right, so I'll speak from One America's perspective with that. So you can access 100% of your value, but they charge the interest up front. Okay, so if let's say I had $10,000 and I wanted to take a maximum loan, I couldn't get $10,000 sent to my bank account because they're going to charge me the interest up front, and then the modal premium depends on what that is. But the biggest one there is they're charging interest up front. So it's like them saying, all right, we're already getting our interest for those first 12 months. Now, if I happen to pay that off sooner, they prorate it and all that sort of stuff. But some of it just comes down to with how the insurance company accounts for the loan. And it's very common that it is an upfront charge from that perspective. So it might come out to be 95% or something like that of what can actually go to your bank account.
Perfect. All right. Thank you for both of those. Keep going.
Yeah. Cool. All right. So 0 repayment terms. And the last one, here's this one. The last one is every payment that you do make on this is 100% liquid, available to be loaned out again. So think of this as a guaranteed increasing line of credit that you do not need to qualify for, you control the repayment terms for, and it can never be closed out on you. Powerful. Okay, now, since the insurance company is lending you their money, would it only make sense that they need to charge you interest for it? Yes, because if they don't, guess what? It's lost opportunity cost for them too, right? So we're going to say that for them doing this, they're going to charge 5% interest, pretty in line with where most carriers are out there today, but they're going to charge you 5%. Okay. So let's take a look at that for a second. Let's say that, get this up here. Whoops, wrong one, sorry. Okay, so what does that look like? Well, let's say that I'm going and I'm going to get this boat, right? And because I control the repayment terms on that, I basically am going to set this up to where I can handle that with my cash flow, right? So let's say that I go, you know what, I'm going to pay off this boat or this policy loan over 10 years. All right, so let's look at that from a monthly perspective, 120 months. I take a loan for 50 grand. One America or the insurance company is going to charge me 5% for it, and I'm paying it off over 120 months. That would mean that my payment is $530 per month. Does everyone see this? Okay. Now, at the end of 10 years, boom, my loan would be paid for. And you can see right here that over those 10 years, I would end up paying $63,639 on that loan. So here's my question. How much interest did I pay choosing to finance that amount at those terms over that time period? How much interest did I pay? Shows you here too. Shows you here.
I'm gonna go with
13,639.
Perfect. 13,639. Okay. So at this 5%, okay, let me do it this way. I am paying back the insurance company at 5%, and I'm going to pay them back the $50,000 plus $13,639 in interest. $13,639 in interest. Okay. Now, here's the next piece, and I was going over some of my notes from back in the day when I would do this with clients, and it has changed some. So just stick with me just for one moment here. Okay. Let's say, for example, that the combination, the long-term growth rate on this whole life policy between the interest and dividend is, let's say, 5%. Okay. Because we are looking at a 10-year time frame, both on the cash and of doing this alone, let's look at the growth of that cash value over that time period. All right, so 50,000, and let's forget adding money to it. I'm just trying to isolate the growth of the cash value here. Let's say it's earning 5% over 10 years. It would grow to 81,345. So how much growth happened inside of the policy during that time frame? 31,445. Do we all agree with that? Okay. So here would be my next question. Over here on the left, the cash value continuing to grow, I'm going to earn $31,000 in interest, but yet over here, I'm only going to pay $13,639. Why is that? Same 50 grand, same 10-year time frame, same 5% interest. And it's because of this idea of compounding interest versus amortized simple interest, right? Let's go back to this piece. It's because of this right here. While I used that $50,000 to go buy my boat and I paid it back over time, my curve was able to still grow, thus building and building and building and building and stacking on each other that whole 10-year time period.
Can you break down? You said annualized interest and simple interest. Is it a difference?
Yeah, so compound interest versus just amortized simple interest. So let me show you. So that's what this would be. So notice that as I pay off my balance, the interest that's being charged every month is reducing. See that here? It's reducing. Whereas on the other side, compound interest is continuing to stack and stack and stack. Okay, now, when I used to do this a little bit ago, the long-term growth rates on the whole life policies would be sometimes in the range of 5%. Nowadays, it's not that high, okay? Largely because of where the interest rate environment has been, a lot of stress on the insurance companies, dividends have reduced, so on and so forth. So let's just go with that for a second. All right, fine. If the cash value is not growing at 5%, it's growing at 4%. All right, I'm still at 74. Okay, so I still increased 24,000. So it's this idea of grew by 24,000, earning less, with a smaller interest rate. Whereas over here, I paid a smaller number. So it's just starting to rewire the way we think about numbers with this and what's actually taking place. Okay, now let me ask you this. Okay, just for my notes, let me write here that I did end up saying 4%. Okay, here's how I want to ask this question. Let's say all of us on this call, the 25 of us, let's say that we're going to pool together all of our money, scrap together every nickel that we have, and we're gonna open a new business, a financing business. And we said, hey, here's our big thing. We know that people are in need of money all the time. So let's make it easier for them to get money. All right, let's offer them part of our money without requiring a credit check. Let's not even check if they're employed. We allow them to choose when they're going to pay us back and how much they're going to pay us back. And each payment that they do make is liquid, that they could immediately go back and loan that out again. If we were going to create that business, would we charge people to use our money as a group? Yeah, I think so. Would we charge them a lot of interest or not a lot of interest? I hope you would say oh, Eric, you coming off mute?
A lot.
A lot, right? That's crazy. Right? I mean, why? Because we're taking all of the risk. Okay. So with that also means that the inverse is, okay, because we have access to that capital under these favorable terms, that's valuable to us. Like us, meaning you and I, of our policies, that is valuable. Okay. So we need to treat this value for what it is. And the fact that we have access to capital under these terms, we need to we need to demonstrate that that's valuable. And here's how I'm going to tee this up. I would coach people and tell them that, look, if you access your cash, not only are you going to pay it back, but you're going to pay it back at an interest rate higher than what the insurance company is charging you. Mind blown, right? Because conventional wisdom would say, no, like, why on earth would I do that? If I can get 5% over here, 3% over here, like, why would I ever pay 5? Like, that's how we're wired to think. But let's watch what's actually happening. Let me pause just for a second. All of us said that we would charge a ton of interest in that business plan, right? Why is the insurance company only charging us about 5? I think we would all agree that that's probably on the low end of what we were thinking. I open this up by saying it is the most secured loan ever. And here's why. If someone passes away with an outstanding loan balance, what do you think happens?
The insurance company pays the loan back.
Bingo. Yes. It is deduct. If you have a $500,000 death benefit and you pass away with a $50,000 loan balance, boom, 450 goes to your beneficiary. So it is the most secured loan out there because the insurance company knows one way or another, they're going to get their money, right? Okay. So now let's get back to this whole idea though, of we need to treat this with value, and the idea, and what we'll end with this, the idea that we need to pay this loan back at a rate higher than what the insurance company is charging. Notice I said higher. Notice I didn't say how much higher, because this starts to be our mental, our thought process, our rules, how we're going to do this. All right, so let's look at that for a second. Here was our loan for the boat, right, that we're choosing to do here. Now, this is being paid back at 5%, which is what the insurance company is charging me. They're not requiring me to pay it, but they're charging me, okay? If I were to tell you, you know what, you should pay this thing back at 10%, double the interest rate. What do you think that will do to my $530 monthly payment? I know you all are thinking, well, it's going to increase, but by how much?
Twice.
Yeah. If I double the interest, my payment is going to be double, right? Let's look at that a little bit further. Sorry for throwing you up a little softball there, but that's what everyone does, right? So check this out. Alternate payback here. If I'm going to pay this thing back at 10%, it's an extra $130 a month. The payment would be $660 instead of $530. Okay, now hear me in this as well. I'm not saying that $130 a month is chump change. I'm not saying that it's peanuts. Okay, it's real money. I would say though that if you made the financial stewardship decision that you could afford $530 a month to pay back your boat, I would venture to say that that extra $130 probably isn't going to break the bank. And if it does, I would argue that, you know what, you bought too much boat. The 530 was a little too stiff to begin with. Okay. But again, it's the idea of paying more. It doesn't have to be 10%. Look at, I mean, heck, 8%. Okay. Let's call it 8%. It's an extra $76 per month. Now, I'll get back to the drawing board here in a second, but well, you know what, let's just go with that. So it's an extra $76 a month. So here from a cash flow perspective, here's what's happening. 530, let me change colors. 530 is going to the insurance company. Boom. There's my payment. There's interest, and it's going back towards paying my principal. But the other 76, where do you think that's going? Is going to my policy through what is called the paid up additions rider. Okay, that quote unquote extra interest, because we're treating our financing options with value, because we recognize that it's extremely favorable to have that extra $76 per month is going directly to our cash value. Now look at this. All right. Each one of these $76 payments over 120 months increased our money down here at the bottom, the money on our side of the ledger by just over $9,000 at the end of that time period. But as the exercise we went through about 5 minutes ago, you all recognize that, well, once it goes into my cash value, it's earning interest and it's earning dividend. And we went conservative and said, all right, let's say that that's earning 4%. That 9,000 that we added is actually 11,000 at the end of that time period, that 10-year time period. Now, here's the next question. At the end of that 10-year time period, does the 11,000 just stop growing? No, it's there, and it's there for the rest of time. This was just one transaction of the $50,000 boat. Okay, Brent, that makes sense. Really, all they're doing is they're saving more money. Yeah, exactly. because of the way that they're now wired in the process that they're going about this, right? I mentioned the kickoff meeting that I believe that to its core, infinite banking is the ultimate cash management savings tool, right? Because if you now are implementing these set of rules that if I borrow I almost caught myself. If I borrow my money, no, if I borrow against my money, I pay it back with a set of rules. I pay back at a rate higher than what the insurance company charges me until it's paid off. There's a great depiction in Nelson's book here that he ties this up to owning a grocery store, saying, don't steal the peas, right? Don't steal your own peas out the back door. You go and buy them out the front door, just like every other paying customer. Okay. So hopefully this is starting to lay the groundwork for where we're targeting areas that money is escaping our boat that we're not even realizing. If we are in tune to that, is there a way for us to repurpose some dollars that are going to do good for us? Guys, where was that extra $76 a month going to go? I can tell you for us, it was going to go on going out to dinner or trying new cocktails. Like, it was going to be consumed, right? This is a way to now put more of that money back into your client's pocket long-term. And you're going to see that as we replicate all this, it's going to be impactful and significant. Eric, I noticed you're off mute. You have a comment?
Yeah,
question,
real quick question. So this might be a second level question, but got it. The extra payment makes sense. Pay more into the policy. How does that affect the MEC of the policy at some point by just overfunding it too much?
Cool. Awesome. Great segue into our next discussion when we go over this, but I am still going to answer you today, Eric. So this is going to come down to, can that policy house that extra cash flow? And the answer is it depends, right? So what I'm going to lay out is it's very common that people will max overfund policies through scheduled PUA contributions right up to that MEC limit, like you were just describing, Eric.
Correct.
Let's say it was $10,000 a year, and 7,000 of that, 6,000 of that was PUA payments.
Mm-hmm.
But then after the policy becomes quote unquote efficient, typically about 5 years, we'll look at that. They strip out the scheduled PUAs from there and they use it to open another policy. And now policy number one has all of that annual flexibility for unscheduled PUA payments such as this. But you bring up an awesome point. It definitely needs to be able to do that. We don't want to create MECs under this context and so on and so forth. So I'll dig into it deeper, but thank you for the tee up.
So basically, since when you start the policy, you put the EBIR on it, and then you're telling me that once you start doing this and that interest could MEC the policy, at that point you stop the PUAs, because the PUAs are obviously optional. You have to keep paying the base of the policy to keep the policy going. Those PUAs then would go into a new policy, which would create a second, let's call it bank account.
Good. Yep.
Okay.
Hey, Brent,
Last thing, Jason, then we can end with this.
Yeah.
Or Eric, what's really cool is I've had situations in the past, clients that received money, let's say it was an inheritance or some form of a lump sum, to where their base premium ended up being what they could cash flow afford come hell or high water to pay. But their PUAs ended up being this chunk of money that they got. And so we funneled that into the policy over X number of years, 4 or 5 years, whatever, until it was exhausted.
Correct.
But they didn't plan on ever putting that in again. They were just going to continue their base. Well, because there was so much front loaded, it came with a MEC number that was high enough that then they could be running all of these transactions moving forward because there was plenty of room to do it. So it doesn't have to be that we strip the PUAs out and use it for another one. It might be that the source of those PUAs were not a repeatable source after a given time frame.
Got it. Makes sense.
Cool.
And then I guess I got one more quick question is
please.
The whole idea that when people start talking about this, I'll even say you got the stock market people that say, well, I could invest my money versus this. What do you ever just say, why can't you do both? Who told you can't take money out of your policy and buy a stock market correction, and then obviously use your policy as a way of funneling it back into the, like, say, for instance, the market goes down 30%. taking a loan out of your policy, you're paying 4% interest, but that money can go into the stock market, and it can go in a compounded vehicle, and then you can pay yourself back through the stock market. What are your thoughts on that?
100%. So this
Okay.
book, The And Asset by Caleb, I always say his name wrong, Guillems, I believe, but young kid, mega producer, a couple million in commissions a year. It was all under that concept. Like, look, people will say that, yes, it's a philosophical thing. Yes, it's a different way of thinking. Yes, we structure the policy perhaps differently on the front end, but so that you can use it. And it's the utilization of that, not just for expenses in life, but also opportunities, whether it's investments, cash flowing opportunities end up being the secret sauce of this, because it's the cash flow that then is paying that back. So yes, you absolutely could buy a market correction in your example.
Appreciate it.
Yes, sir. All right.
Just a couple more things from the
4 minutes
chat.
over here.
Right? Yeah. So this could be something we answer offline unless you want to address it next week. But Saul asked, could you please re-explain how the paid up additions rider works? What determines an excess payment? That gets into some of the technical.
Yep.
We can do that offline, but whatever you want to say to that.
We will, by default, we'd be going over it next week. But if I don't go,
Perfect.
go deep enough, remind me at that point, and we'll do it again. Whoever asked the question.
Okay, awesome. And then Joanne asked, what was the title of that latest book? If you could send me your library of infinite banking concept books on email, maybe, or text, we'll get those out to everybody this week, and maybe even flag some of the easier read ones up front.
Cool. Sounds good. And in the meantime, too, if this is, oh my gosh, I want to hear more, go to YouTube and just type in infinite banking with things. A lot of resources. But yes, thank you all for your time. Sorry that I kept you 5 minutes longer. And as always, send in your questions. Hello, Dennis. Send in your questions, and we will get after it again next week.
Awesome.
Hey, Brent, can I ask you a question? Are you available today by any chance for 15 minutes? I have a client that is taking a loan, and I want to run by you something on how it works, the payoff of that loan.
Yeah, yes, absolutely. Yes, I will. Yes. And I'm so sorry. I just saw that I have a meeting that started 5 minutes ago. So
You can go,
yes,
Brent.
shoot me an email. But yes, after two